Hello, thanks for joining us today. I know people are going to be shuffling in. We have about a little under 50 registrants. And so we will let people shuffle in. I know there's some people that wanted to be admitted that dropped off. Maybe they'll be joining again. So hello. I love seeing a lot of familiar names and faces and also new ones. Hello. Thanks, Melanie's going to admit everybody. We're just going to take one more minute and then we'll get started. I want to be really respectful of everybody's time. I'm really excited to be here with Terry from Lake Michigan Credit Union. Feel free to join on camera if you wish, or if not, we will be taking questions and answers. So do not hesitate. Melanie's going to be helping me moderate. So if you have any questions, you can chime it, ping it straight in the chat. Everybody will be able to see it, so keep that in mind. Actually, other people will be able to see your questions. And lastly, so we're going to take questions at the end. We will be offering at the end, so I hope you stay until the end. We will be offering an uplift, a very simple uplift analysis that we've benchmarked across many different lenders' data. So we will be offering that as the next steps at the end. I'll give more information on that right before we go into questions and answers. Okay, so again, as questions come up, please do not hesitate to chat them, and we will get to them. And so we're taking probably about 25 to 30 minutes max, and we will reserve the end 15 minutes or so for y'all's questions. So just want to put that out there. So I think it's good. Let's dive in. Hi, Terry. Are you ready, Terry?
I'm ready.
Are you ready with your drink? Oh,
sure.
Man, my drink is not visible here. Okay. I have a drink because I talk a lot. So
my drink's visible. Go green.
Okay, no comment, Terry. Okay, no comment. Us in Michigan with our rivalry, right? So
Yes.
I invited, just really quick, I invited Terry, because he just doesn't, he cares deeply about every borrower, and he's just done a phenomenal job with this borrower case study we'll talk about, but he just went through so much of how he improved affordability and helped borrowers, not just with LoanSense, but with other, available tips and tricks in the market, like down payment assistance, paying down credit. There's various things he'll talk about. I'll let him speak for himself and about the borrower. But I just was like, oh my gosh, Terry, you do such a good job. Let's talk about what you do on a webinar so that we can share some of these best practices. So hence we're here. So I'll let him introduce himself and talk right after I go through a few slides, so we give people a few more minutes to join, if you don't mind. So first, I want to talk a little bit about, okay, I care about this problem passionately because I was declined for my first mortgage, and being the founder of LoanSense, I want that to stop across the market, and mortgage and student loans must connect if we want to prevent decline for millennials and Gen Z that's coming up, because it is the largest debt burden. We get in at a very young age. And in order to help us get into home ownership, we have to figure out how to help borrowers with student loan debt. So I'm very passionate about the problem. We have about 2,000 loan officers across over 100 different IMBs, majority. Now we're onboarding credit unions, depository, and we are actually in a pretty big rollout, pilot and rollout with the GSE, and we're already impacting guidelines on student loans and how to help more borrowers with student loans in terms of guidelines and regulations. So I'm really excited about that. So today's agenda, real quick, I'm going to go through really quick student loan update, and then I want you all to participate. We're going to go through a pipeline exercise, okay? And if you don't know these answers, do not feel bad. But I challenge you to get the answers because it will help improve your business. We're going to go through that. Then we're going to talk to Terry about his borrower case study and what we were able to do at Lake Michigan Credit Union. And then we'll go through a quick product capability and then our benchmark uplifted analysis live Q&A. Okay, that's the agenda for today. So To give you a little bit of framing on student loans being a huge barrier for our generation, 45 million of us hold student loans. The highest debt load is held by those in their 30s, which is the first time buyer market, really. People in their 30s hold 40% of the $1.7 trillion. So that's 800 something billion is held by people in their 30s. Average payoff is 43 years old. It's deferring homeownership by 5 years. It's perpetuating unequal housing access, especially for Black Americans and low to moderate Americans. And if we systematically help borrowers enroll into federal programs and understand the best options for them, depending on are they going after Freddie, Fannie, FHA loans, and helping them make right decisions, then we can improve access to low to moderate income and Black Americans by 10% across the United States. So it's a huge problem that if we solve, we can all increase the pie of ready-to-buy borrowers and all help each other and the industry succeed, right? And help more Americans get into homes. So really quickly, I want to go through the student loan update. So Biden rolled out what's called SAVE. SAVE is a program that allows a family of four that earn about $65,000 to make a $0 payment. So this means you have to make over 65 to 66,000. I put 67. It really depends on the family size, but family of four around 66 to 67 to make a $0 payment. And so that's having a big impact because Biden rolled out SAVE. 4.5 million people out of 8 million got a $0 payment. That literally can hurt them if they're trying to go, if those borrowers are trying to go for FHA or Freddie loans, because Freddie does not accept the $0 payment. Okay. The big news is that with SAVE, with Biden's new SAVE program, there is no more negative amortization, which means if someone applies for SAVE and enroll their paperwork again the following year, everything they did not pay, let's say somebody took their payment from $800 to $400, that $400 every month they don't pay for 12 months, does not accumulate on their balance. As long as they file the paperwork the following year, there's no more negative amortization. They get forgiveness year over year. That's a huge update to the program so that we don't see as much or hear in the media or see these growing balances, right? Like you might talk to a bar and they come to you and say, I took out 50 grand and now I have 90 grand in student debt. That's because of negative amortization, right? Just an incredible growing balance. That is now stopped under SAVE. But unfortunately, a lot of people are coming in with zero and being the good old government. They don't talk to the mortgage world. So the mortgage world has all these rules that actually hurt borrowers who are low to moderate income. And so what can we do to stop that? Here at LoanSense, we can see if you want to, after you work with us, you're trying to qualify somebody for FHA, we can warn the borrower against enrolling into SAVE and getting zero and provide other options, okay? So I want to put that out there as a big update. If a borrower gets inadvertently or mistakenly, accidentally, you tell them, hey, go reduce your payment, it's too high, and they enroll in SAVE and now get zero. I mean, if you're trying to qualify them for FHA, now that is, you have to use 0.5%, right? Because Freddie and FHA do not allow for a $0 payment. So again, like I mentioned, we're working this, change this with Freddie Mac. And we'll be knowing soon if we'll see some guideline updates. I'm really hoping that they will move towards accepting zero. And of course, I want to mention, yesterday was actually the deadline of the IDR waiver. However, there's all kinds of special relief programs out there that LoanSense will work with borrowers on, including Borrower Defense, which is a program if they've gone to a for-profit school and they did not succeed. There's many metrics, or the school defrauded them, lying about graduation rates, job opportunities. They have a special program where they can get those loans discharged. There's also expanded disability discharge, people who end up needing, getting a disability or getting diagnosed with cancer treatment. Now there's expanded disability discharge relief. There's teacher loan forgiveness, and there's all kinds of forgiveness based on AmeriCorps, Peace Corps, military service. So first responders, for example, any public servants already have access to public service loan forgiveness. That's existed for a while, but there's also expanded relief across these special programs. So I wanted to bring it out there because if you have a borrower that comes into your pipe and they say they've been paying their student loans for 20 years, or 25 years or something crazy, that is probably a flag in one's mind that there's probably something that could be done to actually get that person to get their payments acknowledged and no longer have to pay them. So through a expanded forgiveness program. So I wanted to put that out there. Okay. Please, by the way, like I mentioned, for those who joined late, if you have questions, please chat them. We will be doing live Q&A at the end. If you came to a demo with me or something where we're more one-on-one, I would take questions immediately, but I want to get to Terry. Okay. So please do chat your questions if they come up. So what does LoanSense do? What we do is very basic for those who are new to us. We lower student loan payments and balance and improve debt to income to boost affordability by, an average 50 to 80,000 in 21 days. The Midwest, since a lot of lenders come to us from the Midwest markets, we're boosting affordability by about 55 to 60,000. If you're on the coast, where more people with grad degrees, we're getting closer to 80 to 90,000 in 21 days. And lenders boost revenue, right, by helping borrowers afford more home and prevent decline. Those are our core value props. So, right, I'm going to do one pipeline exercise, and I want to turn it over to Terry's part here. So, by the way, I'd love for you all to write this down. Again, if you don't know these answers, don't feel ashamed. But the reality is, in this market, nobody can afford unnecessary declines. Like, nobody can afford it, right? So I like to ask people, your brand. You can think about your brand, your branch, whoever you represent, right, in your lending institution. How many leads come in your pipeline a month or quarter, right? You don't have to blurt it out loud. If somebody wants to publicly share how great their numbers are, I'm happy to have them chime in. But I didn't plant anybody to do this. So if you want to volunteer, that's great. Otherwise, I can go over some of the questions. And LoanSense will benchmark this so we can do uplift together, you and us as a brand. But how many leads come into your pipeline a month? And out of that, what percentage of the leads do you pull credit on and that turn into applications? We want to be the dark blue arrow, right? We don't want to have people drop out at every stage. That's inevitable. But yeah, what percentages of leads turn into credit? What percentage of credit pulls turn into applications? And which percentage of applications turn into originations? And what is the core reason of decline? Nationally, with HMDA data, we know it's high debt to income. A lot of people will scream credit, but it's actually high debt to income at the national level. Does anybody have their numbers? They know off the top of their head they want to volunteer. If not, I can jump to how we impact that. Okay. So this is how LoanSense works on the mortgage sales funnel and pipeline and how we can address it. So we have all kinds of marketing assets that brands like Lake Michigan will co-brand with us so that they can reach more borrowers, right? So we're increasing the pool of people coming into the funnel, right? Top of funnel. But LoanSense's actually biggest value is mid to low funnel. And what we do is out of, let's say your brand pulls 100 credit pulls, 100 of them. 30 to 45 of them will have student debt. That's just across the market, across lenders, across all the data we touch. So instead of a borrower coming in and rate shop, what will happen is we will trigger data to the loan officer to identify who we can reduce the debt to income for, so that when that loan officer goes to talk to the borrower, it's not about rate only. It's about, well, we could boost your affordability by $60,000. And they're not going to talk to another lender that can take them from, let's say, 180 to 250, right? Or 240 in purchasing power. So it's not about the rate alone anymore. So we help with the mid-funnel pull-throughs of this 100 credit pulls for the 30 to 45 people. Then secondarily, out of these 100 credit pulls, 10 to 25 of them will have a significant reduction. Significant reduction is defined by above 45 to under 45 debt to income, which means taking them unqualified to qualified or saving at least $100. We let every brand define what significant reduction is. Like the brand can say, don't ping my loan officer unless there's a $200 savings, We let the brand define it. But the point is, across lenders using our data right now, 10 to 25% will get a significant 10 to 25% will get a significant reduction, saving loans. So helping value prop middle and lower funnel. Okay. Please do state your questions. If you are a lender that does servicing, we improve servicing revenue and mitigate loss. And how we do that right now, we don't have to worry about refinance churn because it's not happening. But we help lenders identify net tangible benefit to improve the debt to income on cash out HELOC offers. Also, if somebody is going to default on their mortgage, we can mitigate that loss, especially if they have student loans, by getting a $0 payment. If, let's say, they don't have a job and they can't pay their mortgage, well, we can zero their student loans, get them on a federal program, and now they can use what they don't pay for their student loans. Because, by the way, the student loans will garnish your wages, okay? They will literally garnish your wages. We can get them to zero. They don't wage garnish, and they can now pay their mortgage, right? So we mitigate loss, and lenders can share their servicing portfolios through our data run as well to identify what borrowers we can give those opportunities to. Okay, now I'm done, Terry. This is your portion. I'd love for you to introduce yourself, Terry, and talk about the borrower who we're going to be talking about today, like her case study a bit. Do you want to introduce yourself and talk about her?
We'll do that. Good afternoon. My name is Terry Wickering. I'm a loan officer at Lake Michigan Credit Union in Grand Rapids, Michigan. We are in Michigan in the state of Florida. We have approximately 50 branches, and in the last 3 years, we've averaged somewhere in the neighborhoods of $2.8 billion in mortgages every year. So that's a little commercial about us and myself. The borrower, we'll call her JN at this time. That's her initials. JN is a single mother. She's in her mid-40s. She has a disabled son of 15 years old. She works 2 jobs. She works at UPS 10 hours a week, and she works at the Spectrum Hospital here at Corewell Health at 30 hours a week, and she attends night school full-time to be an RN nurse. She's 2 years through it and has got 1 year left. Jan wants a house. She lives on a rental, and she's paying $1,500 a month for rental, and she wants to buy a house. Before LoanSense, as you can see, she had student loan debts of approximately $35,800, and through LoanSense, working with Melanie and the account agent, we got forgiveness of $15,738. That after LoanSense, we ended up with $20,068 in student loan debt. Her current payment was $221 a month. And after LoanSense and we worked it through, we ended up with $0 a month. And as Kat pointed out, this has to be renewed every year. So we want to make sure that you let your member know that once this is done, put that date on your calendar and do an anniversary on it, that you want to make sure you get it done and you apply at least 30 days prior to.
And we let them know too, Terry, just so you know, FYI, we let the borrowers know too, but go on, sorry.
I just wanted to emphasize that.
Yep.
Her purchase price prior to LoanSense was $150,000 with a mortgage of $145,000. And we know that in our market here, and I'm sure in all your markets, what's out there for $150,000 is hard to live in, especially with a 15-year-old disabled son. After LoanSense, we increased her purchase power to $220,000 and her mortgage to $213,400. The big thing is the debt to income ratio. We lowered it from 56% prior to 43.5% after LoanSense. Along with, I'm sorry.
No. I was just gonna say, Terry, do you want to talk a little bit about what you helped her outside of student loans as well? Because I know why I scheduled this webinar is I was like, oh man, Terry's really good at helping borrowers think about their debt to income. So I'm sorry if I interrupted your train of thought.
No, you're good. You're good. You're good. The 43.5% was a result of after we reviewed all her outstanding debt and worked with the LoanSense with Melanie, her counselor, how to, and her agent, how to work through it. We ended up with paying off $5,000 in her open debt. Now, she had cash, so that's sometimes a little different than most people. They don't have a lot of extra cash, but she did have the cash to reduce that. And we reduced as we said, the student loan monthly debt from $221 a month to zero. And the $5,000 relieved an additional $400 a month in debt. So with those combinations, that's how we got from 56 to 43.5. And I held her hand and twisted her arm a little bit to make sure she didn't go out and feel she had extra money to spend and go open new debt until we got this done.
So Terry, can you talk a little bit? The reason she had that 5,000 though was because you helped her access a down payment program that required a lower down payment. That's why she had the extra money as well, right? Do you want to talk a little bit about that? Because I think that's really key, was you helped her move some of her down payment savings money to be able to pay off debt because of a down payment. And although we're not a down payment savings program, I really want to drive home that bringing together all the resources is what gets people over the byline. It's not just the student loan, right? So do you want to talk a little bit about that? And I know every state has different programs, and we have a great partner that has access to being able to search those. But I just wanted to ask you about that because I think that was huge to why she had the 5,000, right?
Yes, we reviewed and went through the MISHDA program in the state of Michigan, which allows for a 1% down versus a 3% down to start with. So that reduced the amount necessary for the down payment. And it also allows for a $10,000 delayed down payment and for 30 years, and it's at the end of the world, and there's no payment on it, and it doesn't hit your debt to income ratio. And by doing that, we reduced her cash to close by $4,400 that she needed to come up with, which freed up the $5,000 to pay down the other items, which increased the debt to income ratios, which went full circle and helped us get her to the point where she could happily go out with a realtor with a pre-approval letter and find a house.
Amazing. I love to share the full story, right? Can you tell Terry a little bit, because a lot of loan officers that roll out, especially at brands like credit unions and banks, tend to look over our marketing and training program. And I know you went through it, so I'd love for you to tell us a little bit about the LoanSense marketing and training program in order to help you. Like, what did it do for you, in terms of being able to speak to borrowers? I just wanted to ask about that.
To start with, when we first were introduced to LoanSense, like some of you are today, I'm sure most of you didn't know what it was, but wanted to find out. We got the credit union went and reviewed it and then presented it to us. And after an hour's meeting, I was lost. Had no idea what we were doing, but it just so happens that JN had been in my office the morning before. And I said, I've got a candidate to make this work. Let's see if it really works or if it's maybe just a fast talk story here. So I went to and found the LoanSense training program. I opened that up. The training program is made up, Kat, help me here, 16 or 18 vignettes of they're anywhere from 5 minutes to, I think the longest one was like maybe 18 minutes. And the questions at the end were anywhere from 2, and the most I think was 6 or 8. And it took less than an hour and 15 minutes to do. And when I walked away from there, I went from acquiring the simple information that made me feel like I understood what I was speaking about versus the complex listening to the story, but not understanding what it was all about. The knowledge helped for me to be more confident in LoanSense and present it to JN and feel confident that I was giving her really the true information of what LoanSense would do for her. And that was the sales program, because they're sitting there and they're saying, yes, 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 but they're not convinced. And that steps us into the next thing, what we have to do with teamwork, which is with the loan officer and has to be in contact with LoanSense account manager. And you have to encourage, I had to encourage JN for 3 weeks. I called her every other day to make sure she was answering the initial email that helped her set up her account. And once she got her account set up, the account manager at LoanSense worked through it with her to enter the simple information which was necessary for her to get the basic information in the loan. Then the account manager pushed it through the process on the back end to come up with, in approximately 2 to 3 weeks, the results of 0 payment.
Absolutely. And by the way, I just wanted to add, we also get the guideline compliant docs for closing. So really, we work hand in hand with you all. Once they come through, we help you, partner with you to pull borrowers through. And that's how we can get a 45 to 55% pull-through rate once the borrower comes to us. But we really rely on loan officers by triggering alerts up front. Thank you so much, Terry, for sharing. I just want to continue. Terry shared the case study of a borrower, but I want to share the case study of LMCU pipeline, right? So through the data run with LMCU, in pipeline pre-approval, about 135 loans, and the average reduction is actually about 350. That's the average in the pipeline. And also, out of about 135, 35 get significant improvement, meaning we're moving their debt to income from above 45 to under 45, okay? That's the majority of this 35, which is about 26% of those with debt. And so again, if you think about the mortgage funnel, we're able to help you pull through each time you run your data with us. We can help you pull through 35 more loans as an institution. In this market, that's everything, right? If it's like Jan's story and it's like $200, or in other people's instance of $300, $400, $500, everything moves the needle in terms of access and making your loan officer the hero, right? The loan officer doesn't have to manually enter anything. Once we set up the data, we will trigger an alert to the loan officer when we can save the loan. And we're really making the loan officer front and center, being able to serve the borrower, but we can provide the data analytics and capability to help them work better. So outside of Terry's case, we had a national lender that rolled out with us. They're much bigger. Their average reduction was $526, average DTI improvement 7.42. They do a lot of volume on the coast where student loans are higher. 3 months, they rolled out our data, 89 clients served, improved purchasing power of $71,000. So now I'm going to come to Q&A basically after I talk about our product capability. So we can automate your pipeline review. As soon as people submit apps, we can review the data, ping an alert to the loan officer, full admin capability to see where your borrowers go, and then of course help them pull the docs for the mortgage process. Those are the three biggest capabilities we provide a lender. And I want to invite you all, before I take questions and answers, which I would love to take. I don't see any, so we must have done such a good job, Terry. Please go ahead and ping Eddie if you have. I do want to invite you for a pipeline review though. And what that means is all a pipeline review requires is the last 4 quarters of your credit pull data as an institution. So if you could get us a high level, what are the number of credit pulls your lender, your bank, your credit union did in the last 4 quarters? We can use data from other lenders to benchmark what a pull through would look like. So I want to put that out there, an expected uplift. If you're interested in this, please do ping the chat and or email us at lender@myloansense.com. We'll make sure to follow up with you and get the 4 quarters of data so we can benchmark what uplift looks like so you can truly understand what that would look like. So I just want to point that out there. And you can, by the way, you can chat questions or ask us live. And how we work is we analyze the data, alert the loan officer when we can save the loan, invite the borrower through, and then get the documentation for close. Okay, that's literally 3 steps. We ping the loan officer with an email that looks similar to this. Hey, your client Jane Doe is projected to reduce their student loans after we do the pipeline analysis so that the loan officer can know of the reduction across that week's data analysis.
Sure.
And again, I'm opening for questions now, but I just want to leave this up here in terms of if you all do want to get a pipeline review, just share your credit data with us over the last 4 quarters. Ping us if you're interested or email us at lender@myloansense.com and we can get that pipeline analysis going. So let me open up for questions. Chat it or chime in as you so please. Yeah, I open the floor for questions and or comments.
What does the borrower have to do to qualify?
I'm sorry, who asked me that?
Terry's friend.
Chuck here in the office.
Oh, Chuck. Oh, what does a borrower have to do to qualify? They just have to have federal student loans. And the benchmark we like to use is like the higher student loan balance to income they have, the more reduction they qualify for. So it's just basically saying the higher student loan balance, let's say you have 100,000 in income and you have 75,000 in student loans, you're going to get a pretty significant reduction especially if you have over that because you have a high student loan balance to income.
Okay, so let's say we have a husband and wife.
Uh-huh.
And the wife can only work part-time because they have a brand new baby.
Uh-huh.
And they've now outgrown their current home and she's got 50,000 in student loans, which exceeds her income.
Uh-huh.
So
and she's also only working part-time. So yeah, she definitely, and if she doesn't make 50,000, she makes less than that, she definitely qualifies to reduce her payment, especially if it's federal student loans.
okay.
So if she doesn't work at all, let's say she works part-time or doesn't work at all, like she essentially could qualify to get her payments to 0. And in that instance, like, it depends on how much the spouse makes, but that's why at LoanSense, we'll even go over like, hey, if you marry and file your income taxes separately the following year, they won't count the spouse's income at all. We're not tax accountants, but we give them numbers on their student loans, and that could reduce their payment even more, right? So likely this individual will have a payment because they'll use the spouse's income, right? If they're filing jointly. So there'll be some kind of payment because it's not quite 0. But a lot of times we'll do that analysis. A lot of times both people have debt, they both have income, and we analyze against that as well. But it's likely that they will get their payment lowered just because there's less income in the household overall. And unless they're earning 250, 300,000, they will get their payment lower.
Okay.
Kat, the one thing I want to bring up too is that the one thing, one of the questions that the member will get when they're filling out the online questions, at the end, there's a cost to do this of $400 plus or minus that they can pay. We at Lake Michigan Credit Union, we pay that for them. So that is a hurdle that you can get over with them because they hear they have to pay something, and that was one of the hurdles I had to get over.
Okay, so real quick, just to specify, the borrower cost, if they were to pay, is actually $244 or 3 payments of $89. Just so I can make it clear. And how lenders roll out for that cost is different. Some lenders will be like Lake Michigan, hey, we'll pay for it, especially if you go unqualified to qualified, we'll pay for it. Other lenders will say we'll credit at close. Other lenders will say we'll buy a discount. So we work with the lender based on their budget, but the idea is that we need to get the information out through a pipeline review is what I like to tell people, as in like not relying on loan officers to only manually crunch something, right? But if every pre-approval comes in with a credit pull, we can get that information out to a loan officer, the better. Because if it stops a borrower from qualification of a mortgage, they will likely act, especially if they're at risk of decline, right? So I just want to throw that out there. But that's a good point, Terry, that the cost can definitely be a barrier, but how the bank or credit union or lender wants to handle it is an individual lender choice.
That was the big hurdle to get over with JN, and from that forward, it was go get it done. So.
Yep. Any other questions or
Yeah,
comments?
I have a question, Catalina.
Yes. Hi, Rodney. How are you?
Hey, how you doing? Okay, on the example you gave for Terry, you were able to get the balance reduced by $15,000 and get it to a zero balance.
A $0 payment, not balance.
A $0 payment. You're right. I'm sorry. So
No worries.
now with the credit union, because they have their own guidelines, they can be okay accepting $0 payment. But say for instance, I'm doing an FHA loan. In that same type of example, where would you be able to get the payment to where our underwriters will find it acceptable?
Well, here's the thing. Even Lake Michigan still follow conventional FHA
Okay.
guidelines, right? So the thing
Correct.
is like, so here's the thing. If you invite a borrower, Rodney, through your dashboard and you identify them as wanting them to do an FHA, we will find them an income-driven program that will take a higher percentage of their income so that they get like $20 to $50 instead of $0.
Okay.
So
all right.
when you invite them and alert us about the product, we keep the product in mind
Okay.
in order to make a better decision. And that's also a difference between having a borrower do it themselves versus us helping them, as we know based on what the lender says on max student loan to qualify and also the product, we know what program to enroll the borrower into. Does that make sense?
Makes sense.
I think for Jan's specific scenario, from my understanding, is we also got her assessed for another program that could have put her payment at $21.
Correct.
You see, so we did think about that as
Okay.
well. So we just didn't go through all that detail in the webinar, but as a loan officer, that's very important. I understand that.
Okay.
Any other question?
I got another question.
Of course.
Say for instance, I meet somebody and they said they're already going through or let me back up. How do people know when they're eligible for student loan forgiveness, outside of LoanSense?
They can go onto the federal calculator, but with LoanSense, they can get also an estimation for free. If you invited them through and they got started, even if they don't go all the way to enroll with us, we give them what their loan forgiveness values will be upfront for free.
Okay. The reason I asked that because if I have a situation with that and someone says they're eligible for student loan forgiveness, I would tell them, and you ask me that, and tell me if I'm correct, that hey, I understand that, but if you put if you go on the contract, you have a clock ticking then, and a seller's not gonna wait for everything to be processed. And the reason why you should do LoanSense is because they are experienced in that, and they can help you get the process expedited or put you in a position where you can qualify until the student loan debt is forgiven. Am I saying that correctly?
Yeah, so let me go over let me answer that. So what we do, Rodney, to clarify the process is we'll enroll the income driven plan first so that they can get a reduction, just like Jane's scenario. But Jane's scenario is also, she is public service qualified, right? So we can enroll all the paperwork to get her loans on a track of forgiveness faster. And that could be even outside of the mortgage close process. Like, we get the payment down first, and then they move towards their march towards their closing date, and we can work with them to enroll public service loan paperwork, various other paperwork directly with their employer to actually even shorten the amount of time they have to pay their loan. So we do that so that we can not just get their payment lowered, but actually get access to forgiveness. So many people that are, especially public servants, work at hospitals, schools, universities, government, they'll get their payment lowered, but they won't file the right paperwork to actually get it on a pathway to forgiveness. So we eliminate all the issues with people having to figure out what they have to file, and we just are TurboTax for student loans. They answer a few questions, we auto fill it out and submit it for the e-file it for them so that we can actually get them access to loan forgiveness. They're not just lowering their payment and paying forever, right? Because a lot of times servicers don't even track how many payments. And if you're not tracking it, it's not good. So we have to help borrowers. On the credit, it'll report how many payments they've made, but nobody's really tracking the total payments unless you enroll into a specific program and you actually enroll the paperwork to get forgiveness. Nobody's tracking. You can pay indefinitely. This is why about 10% or so of people who come in will actually get their loans forgiven through us, because loan officers and lenders will send them to lower their payment, but we actually get them forgiven, you know? And so to clarify again, it's separate paperwork for loan forgiveness, and it's an extra step that we make sure to take for borrowers who qualify for that.
Okay.
Yep. And you have to certify every employer if you're going for public service loan forgiveness. So we take it out of their hands of having to figure it out, and we just do it for them. So or assist them in doing it. They e-sign it and then we submit it. But that's a good point, Rodney. We're coming up at about 2 minutes till the end. Super grateful, Terry, for your time. That example, I just love to talk about it since you applied so many different things to help your borrower qualify. That's why I wanted to talk about it. It's really best practices and what a advisor would do, right? So I really appreciate that. Are there any other questions? Otherwise, we will certainly follow up with every registrant to see if they're interested in sharing their credit pull data, and we can benchmark uplift by rolling out data, automated alerts to your loan officer. Any other questions? Last one before we go. All righty then. Thank you so much for all your time. Of course, we're always here. Again, lender@myloansense.com. Ping us at any time with questions. We're happy to answer them. And I know it's a tough market right now, and I hope some of this was helpful to thinking about best practices on how to help borrowers qualify. Thank you all for your time. We do have a recording, and we're happy to share it out so you all can share with your team as well. Thank you.
Thank you.
Thanks. Bye-bye, everybody.